Hi, my name is Phil Elrod. Welcome to Chapter 3 in our series of videos describing our new ebook, See the Music of the Market. In Chapter 1, we discussed how to see the music. In Chapter 2, we discussed how to see the trade. In this brief video, we're going to describe how we construct our trades. The most important tool in our arsenal are our SRVs, our support and resistance values. We use these values not only to see the music of the market and to see the trade, but we also use these SRVs as specific values on which to construct our trade. We notice that the oscillations on the chart included in this diagram are 12 to 20 ticks, and the distance between SRV1 and SRV3 is 17 ticks. The trend is down, so we would be looking to make a short trade. The way we construct a short trade is as follows. By selecting an entry just below SRV1 and a target exit right at or just above SRV3, we can see a potential profit of approximately 15 ticks. If we set our initial stop loss just above SRV1 at about 5 ticks, our potential profit on this trade as opposed to the risk is a factor of 3. This makes for a very good potential trade. The next trade on this diagram would be a long trade, where we would enter the market just above SRV3 with our stop loss a few ticks below SRV3, our target price at SRV1. However, price was unable to break through SRV2 and we were stopped out with a small profit of 3 ticks. The next trade on the diagram is another long trade. It's set up exactly like the previous long trade, but in this instance we were more fortunate and the trade went exactly as planned, once again netting us a nice 15-tick profit, which is 3 times our risk. This should give you a pretty good idea of the importance of our SRVs to our trading method, but we have a number of other tools available that we use predominantly to evaluate whether or not the potential trade we're constructing should be executed or not. This is what our computer work screen typically looks like. There's a lot there, so we will discuss each one individually and then once again discuss how they're put together and why. Our trading method employs the use of 3 intraday charts. The first chart, we call it our primary intraday chart, typically displays about 1.5 to 2 weeks of data for the market that we're trading. Our secondary intraday trading chart, and the one we most often use for constructing our trades, typically will display about a day and a half of intraday data. This chart will be set from anywhere 1/5 to 1/10 the number of ticks per bar as our primary data chart, so the music plays a little faster on this chart. We use a weekly and a daily data chart primarily for establishing our SRV values, but we like to keep them on the screen available just in case we might need them during the working week. We also like to use a single tick chart primarily for monitoring the current price activity and momentum of price, particularly when we're trading the Forex markets. The other 2 windows making up our screen workspace is a time and sales window, which we like to watch for seeing if the trade is going at the bid or the ask, and the quote page window, in which we use primarily for watching the spread, that is the difference between the bid and the ask. All of these windows are arranged as you see them here, including the order bar at the top of the screen, the daily and weekly and behind, and the 3 intraday charts up front make up our workspace, along with the tick chart, the time and sales, and the quote page. You can learn all about how you set up and use these trading tools in our new ebook, See the Music of the Market, which is available from tradingbetweenthelines.com. Once again, that's tradingbetweenthelines.com. And be sure and check out our blog at tradingbetweenthelines.com. We're often posting useful information for short-term traders, including trading tips, commentary, and other stuff you might find interesting. Thanks for listening, and be sure and check out the next video, which will talk about logic of trading.